AI stocks are bleeding again. Oracle and Broadcom, two titans that once symbolized unstoppable growth, have suddenly reignited the fear of an AI bubble. Investors are rattled, headlines are screaming, and portfolios are flashing red. But what if this panic isn't the beginning of another crash, but the beginning of a once-in-a-decade opportunity? Hey, Bo, Thai Nation. Joseph Hogue here with your weekly stock market update. Every Monday morning at 9 a.m. Eastern, we cut through the noise and look at the truth behind the market. Today, we're diving deep into the chaos shaking Wall Street, and I'll show you exactly why this sell-off might be the perfect moment to buy, along with the 5 stocks I'm personally loading up on right now. Last week, AI stocks buckled under the weight of fear. Oracle and Broadcom both fell more than 10% after their earnings, dragging the entire AI sector down. But here's the twist. Their numbers weren't bad at all. Broadcom's earnings were spectacular, reporting 28% revenue growth to $18 billion, $500 million above expectations. CEO Hoque even said AI chip sales would double next quarter, supported by a $73 billion backlog of orders. Yet despite all that strength, the stock plunged 10% as investors obsessed over a single risk concentration. $21 billion of that backlog came from one customer, Anthropic, and the fear was simple. What happens if that one customer backs out? The entire fortress could crumble. Oracle's situation echoed that same anxiety. Revenue came in slightly below expectations at $16 billion, though earnings per share beat forecasts. The real problem was debt. Oracle proudly announced a 400% jump in its AI cloud backlog to $523 billion, but investors saw the cost behind the promise. Building those data centers will require nearly $50 billion in yearly spending, financed by $20 to $30 billion in new borrowing, on top of the $100 billion Oracle already owes. Even worse, more than half that backlog, roughly $300 billion, depends on a single client, OpenAI. The company behind ChatGPT is promising trillion-dollar deals while generating a fraction of that in revenue. Investors looked at those numbers and realized that one crack in the system could send the entire structure tumbling down. As panic spread, the AI-focused ETFs followed. The Global XAI and Technology Fund dropped 2%. The Bots ETF fell 4%, and the Wedbush AI Revolution ETF plunged nearly 7% from its highs. The fear was contagious, but it wasn't fatal, because what's happening isn't collapse, it's correction. Market corrections happen every year, dips between 5 and 10% that shake out the weak hands. In the last 45 years, 26 corrections ended without a full-blown crash. Every single one turned into a buying opportunity. And yes, the AI spending boom feels a little like the dot-com era, but this time, the technology is real. NVIDIA just reported 65% sales growth. Google's cloud boss says the company must double its AI capacity every 6 months just to keep up with demand. Even in the middle of fear, companies like Broadcom and Oracle are posting double-digit growth. This isn't a bubble, it's a recalibration. AI is already everywhere. Last year alone, 223 AI-powered medical devices were approved, nearly double from 3 years ago. 78% of businesses now use AI in at least one area, up from 55% the year before. Companies are pouring $110 billion annually into AI infrastructure. This isn't a fantasy. It's an industrial revolution unfolding in real time. So while others panic, I'm buying. Broadcom is my first pick. After a 12% drop, its valuation is suddenly attractive. The company's fingerprints are all over the AI ecosystem, from networking hardware to accelerator chips, with major deals tied to NVIDIA, AMD, and OpenAI. Analysts expect revenue to double in the next 2 years, yet shares trade at only 17 times sales. That's not a bubble. That's discounted innovation. Next up is Amazon. While the market panics over AI names, Amazon quietly dominates every corner of the digital economy: e-commerce, cloud computing, advertising, and logistics. Its 12% revenue growth might sound modest, but that's built on a foundation of massive diversification. At just 3.8 times sales, Amazon is absurdly cheap for what it represents, a tech empire still expanding. Then there's AMD. The stock's already up more than 100% this year, but even after that run, it's still undervalued relative to its growth. AMD is set to surprise the market with rising profitability, and I see it as the second chance investors missed when Nvidia first exploded. Fourth on my list is SoundHound AI. It's been crushed, down 53% from October, but the story isn't over. The company is leading the next wave of voice AI, powering in-car systems, drive-thrus, and customer service bots. It's already partnered with brands like Hyundai, Jeep, and Oracle, with revenue expected to nearly double this year and grow another 37% next year. This is a comeback play hiding in plain sight. Finally, Supermicro, ticker SMCI, the purest AI infrastructure stock out there. It's volatile, yes, but it's also essential. With 22% market share in AI servers and ambitions for 30%, the company projects 65% revenue growth this year. And after its recent sell-off, it's trading at just half its usual valuation. This is the kind of deep value opportunity that only appears when fear blinds the market. Beyond AI, I'm also watching the shift in safer sectors. Energy stocks have done well, but the oil market looks oversupplied. Real estate, on the other hand, is starting to look interesting again. Property valuations are at their lowest point in 25 years compared to the broader market, and big institutions are quietly buying again. Names like American Tower, Boston Properties, Extra Space Storage, and Digital Realty all offer solid value and stability in a turbulent market. This week, all eyes are on economic data, jobs, and inflation numbers that could shape the Fed's next move. The market expects only 50,000 new jobs and inflation still above 3%, hinting at slower growth and lingering price pressure. That's not a crash scenario, but it's enough to keep investors uneasy. Still, the S&P 500 and Nasdaq are down less than 1% from all-time highs, and AI-focused ETFs are off by just a point or two. This is a correction, not a catastrophe. So here's the truth, nation. Fear creates fortune. Every major dip, every sell-off, every panic has a silver lining for those who stay focused on the fundamentals. The investors with research, conviction, and patience, they're the ones who walk away richer when the smoke clears. I'll leave the links below to the investing platforms I personally use: SOFI, Robinhood, and Moomoo, all offering free stock bonuses. And if you haven't already, tap that subscribe button, ring the bell, and join the Bowtie Nation. Because in a market full of noise, we don't panic, we plan, we prepare, and we profit from opportunity. I'm Joseph Hogue, and this is your moment to buy the dip.